Joining us here at Post 9 this morning, Goldman Sachs Chief U.S. Equity Strategist David Kostin keeps his year-end of 5,600. DK, good to have you back.
Nice to see you.
You stayed with the target because you expect some chop in the next couple months?
Well, the historical experience ahead of elections is the market tends to go down, volatility goes higher, and then once that uncertainty is resolved, the equity market tends to rally. And so that's the broad framework that we think about. I think what's most interesting, Carl, is the mid-cap stocks. And in our conversations with portfolio managers, that is an area that is really not well focused on. It tends to be large-cap stocks or small-cap stocks. And there's a lot of compelling arguments on why mid-cap stocks. Think of the S&P 400 as one sort of representation of that. And the reason that is they have a long track record for decades of outperforming. Their valuation right now is around 15 times, in line with their historical average, whereas the rest of the market, say the S&P 500, trades at 22 times, very, very expensive versus history. They have the best torque to a Fed cut in rates. When the Fed begins to cut over 3 months, over 12 months, mid-cap stocks outperform large and small cap. And so that's the argument. And the intuition or the analytics behind why that's the case is that 25% of the balance sheet of a mid-cap stock is floating rate. So that's a one-to-one benefit. When you have the Fed cutting, you have less interest expense, you have increase in earnings, positive earnings revisions tends to lead to outperformance. In contrast, larger cap stocks have around 7%, so not quite as much torque. So that's the framework and why there's best performance in mid-cap stocks.
What's mid-cap? Sorry, just real quick. Define
mid-cap's going to be somewhere between $5 billion and $25 billion in market cap. That's going to be the sweet spot of where you see these companies. And in our conversation, Dave, when we go to London, we visit on Zoom, a lot of clients with the hedge fund world. They're just not an area of focus. They tend to be focusing on the big cap, the AI story, some of the small caps, but mid cap is really less focused on.
That's a concern overall, though, isn't it, David? There's just not much price discovery anymore. You don't have that much active management. Everybody's following an index, and so will they ever get the sponsorship they deserve?
And so what you should think about it as these are the survivor bias. You have smaller cap companies, those that actually continue to do well, going to get promoted into, if you will, the mid cap area. The small cap stocks, one of the reasons here is 36%. A third of those, the whole Russell 2000 index actually loses money, negative net income. So that's a challenge, if you will. So you've got positive earnings, you got valuation, you got a long track record, and you have the best torque to a Fed cut. And that's what we think happens.
Although some point out, if you look at it market cap weighted, that percentage of negative earnings is smaller, maybe in the 20s. Yeah.
So if you want to think about it, a large percentage of those companies are still challenged in this environment.
So you'd avoid small and you'd go large mid.
Relative, I would say mid. Mid cap is your best expectation. Our best expectation of returns probably get something like 13% return in the next 12 months. That's the best opportunity set we have. You look at the large cap stocks, maybe 6,000 if we look out a year on the S&P 500. So still positive earnings, positive trajectory on the index, but I think the best opportunity
and is that
mid-cap.
Contingent on a certain amount of Fed cut?
The expectation is, both in the forward market and Goldman Sachs economics, is you have a series of cuts in the next 9 months. We'll take probably Fed funds down, probably 200 basis points, and that's the general trajectory. The economy grows, revenues are growing. It's generally a pretty optimistic view, but valuation is going to constrain, in our view, my view, the magnitude of the upside.
I mean, it all sounds nice, David, and then we have a headline that the U.S. has indications that Iran is preparing to launch a ballistic missile at Israel. And what's working today? Northrop Grumman is up 3%. Lockheed Martin at the very top of the market, up 2.5%. How do you process the geopolitical risk ahead? Never easy for equity investors. Oil's turned around, but again, has not really reflected what's at stake here, especially as Iran comes to the forefront.
So it's obviously a difficult situation, both from a humanitarian perspective, geopolitically, but from a fundamental, from economics, and from a equity market investor. It's what's happening with the economy, and is this likely to affect the general thrust of the pattern of where we see economic activity in the United States? And the answer is probably less directly. But you identified, aerospace defense stocks, sort of first order. If you want to think about energy generally, would be, from geopolitical uncertainty rising, that is, if you will, a first-order benefit. But more importantly, the broad trajectory of the economy is likely to continue to grow.